Hey everybody, and welcome to Yahoo Finance Live. I'm Dave Briggs along with Shauna Smith. Happy birthday, my friend.
Thank you. It's a great day.
And happy birthday to Yahoo, I believe, as well.
We share a birthday. Who knew? I didn't know until today.
Who knew?
Great day, March 2nd.
Yahoo. All right, let's get you up to speed on the market action with an hour left in trading. Stocks are, let's see, all pointing up at this hour, just at 3 o'clock, and we're looking up solidly in the Dow. A little bit of a rally, perhaps, on the words of the Fed. They just keep on talking, don't they? S&P 500 up 21 points, and the Nasdaq up a half percentage point. One of the biggest stories of the day, the Tesla disappointment. Shares trading lower, 6.5% lower after Elon Musk and the Tesla team. Uneventful Investor Day presentation will tell you what the lack of major announcements means for the stock. Why are investors so bummed out, Shauna?
We certainly are bummed out with that drop of just about 6%. And then there's also Salesforce. Totally different picture there. Shares skyrocketing up just about 12% after a huge fourth quarter report. CEO Mark Benioff telling Yahoo Finance that the company has, quote, hit the hyperspace button following an onslaught of activist investor interest. We will have more on Brian Sozzi's interview with Benioff here coming up in just a few minutes.
All right, can't wait for that. But first, let's get you up to speed on what's happening with retailers. A number of retailers reporting earnings this week. Many warning of consumer weakness for the year ahead. Yahoo Finance's Brad Smith works all the time. Fortunate he just hangs around for our show as well, buddy. We appreciate that. You're working a little OT for us, brother.
Yeah, I'm going to be ready to take a nap in a little bit Steph Curry style, at the end of this day. But for right now, we got to focus on these retailers here. And happy birthday, by the way, Shauna, as well.
Thank you.
Well, retail, it certainly has been a challenging quarter for the retail sector. Jerome Martis told Yahoo Finance this week that the value proposition is key to the consumer, and the consumer will only up their wallets if they feel that they're getting a good price or a good discount. And data from the firm in collaboration with Centriprise revealed that average promotions, they rose in the month of January, which, even if helpful in churning inventory, can compress profit margins. So, who among the retail environment is best positioned to weather economic uncertainty, and which companies carry the most risk? And the answers, they've been apparent in many of the sector earnings reports as results and forecasts have poured in from companies like Kohl's, Lowe's, Walmart, and Target even, just to name a few. So we've got two businesses, and two of them are outliers and two of them not so much here. So the outliers to the positive side, you've got Kroger and Dollar Tree. Kroger shares, they're rising today after beating on earnings and issuing a strong forecast despite some macro headwinds. Let's linger there for a second on Kroger here, particularly because that strength that you've been able to see in the grocery category, that's even as some of those items that are getting placed in the cart, they're still costing more. But at the same time, this is such a necessity, and Kroger plays a critical role in that. And given what Walmart, one of the other, if not the major grocery categorical leader, or at least market share leader here in the US, has said, they still see strength in grocery. It's just about where consumers might be trading down to some of the homegrown brands that Walmart or that Target may be citing strength in their grocery departments and aisles as well. And so within that, they still have a little bit more of that exposure to discretionary than a Kroger here. So Kroger, one of those companies that's an outlier. Dollar Tree is down despite reporting strong earnings. But beyond the share price action, dollar stores continue to undergo some of the store expansion plans, increasing their footprint at a time when a lot of the other retailers are reevaluating their cost structure. We had discussed this earlier this week as well. Dollar value stores, they have shown some strength in same-store sales, even compared to pre-pandemic periods here. So let's shift from two of the outliers to the positive side to some companies that are not doing so great. And we'll start things off with the earnings from Best Buy and Home Depot here. First things first, Best Buy falling today after reporting a downbeat full year outlook here, and zeroing in on some of the comments that came over the course of the earnings call. Corey Berry, the chief executive officer at Best Buy, said that they are expecting most comparable sales pressure in the first quarter as year over year compares ease through the year. But based on what they can see right now, they believe that calendar 2023 is going to be the bottom for the decline in tech demand. That certainly impacts them because if there's anything that we've heard from other retailers, it's weakness in the discretionary categories, and Best Best Buy has got a whole store of discretionary purchases there. And let's talk about Home Depot. Home Depot shares, they fell off after reporting earnings last week. Now, the retailer offering some flat sales guidance for the year here. And one thing that was also called out by the Home Depot Chairman, President, and CEO Ted Decker was saying that while we expect this to be a year of moderation in demand for home improvement, we believe that the long-term underpinnings of our market remain strong and that they're well positioned to leverage distinct competitive advantages and capitalizing on compelling growth opportunities in their space. But it still comes back to where those DIY projects are taking place within the home, and then additionally, how they're impacted by the broader housing market as well, even among some of those larger contractor purchases too.
Yeah, certainly. It will be interesting to see what exactly we hear from Home Depot, or see from Home Depot, I should say, in the coming quarters. Brad, what stuck out to me was some of the Kroger results, and specifically what we saw in some of their private label brands. And it's very consistent to what we have seen or what we have heard from the company in the past. Once again, that was an outperformer, really showing that people are trading down. They're very cost conscious. They're figuring out, they're trying to save in every single way they can. And a lot of times they're trading down to those private labels. Trading down, a lot of times those private labels are actually what I prefer, but trading down, technically speaking, in terms of some of those cheaper options, and it's paying off, or at least Kroger is able to navigate what is certainly a very challenging time.
I chuckled only because it was the number one thing that stood out
There we go, we agree.
among all these earnings reports. Because when you go back even earlier in the week, that's what stood out to me. When you look at overall private label earnings are up 11% in 2022, and Target saw 18% increase in the private label. And what did Kroger see? 10% increase among their private label goods. So that is where I think all of these companies are focusing. The one thing I can never figure out here, Brad, is look, we know there's a shift away from goods to services, but how do we explain the insane travel people are doing and able to afford when they're making cutbacks at Walmart and Kroger and Target? And I know we're not going to talk about travel, but it's a strange dichotomy happening in this economy at the moment. Let me ask you this. What does what we learned today mean as we get Nordstrom today and Costco? Because Costco certainly heavy on the groceries, but also, I don't know about you, but Costco's discretionary, man. I mean, people go by there and buy golf balls and
Kirkland
tequila and sweatshirts, so it's not all essentials there. What do you think it means for those two?
I'm going to attempt to tackle everything. So you mentioned travel, you mentioned buying
I mentioned
in bulk,
way
and
too
you
much.
mentioned
Sorry, dude.
a very affluent consumer. So first on the travel front, counter-cyclical recovery, right? And so if some of those dollars that they typically would have spent on goods, on the lavish tech that they may have been putting into their home, anytime you hear on a call like Best Buy's where people may already be well positioned in the number of smart speakers or need-based tech that they already have, then there's more of a cycle turnover that we're still waiting to come. So that's on the travel side. And then you think about the buying in bulk, which we're going to be talking about with Costco as well. Of course, people are looking for those deals, looking to offset some of the price increases on a per unit basis. And what does that mean? That means buying in bulk. And particularly for Costco, given the fact that they do have grocery and so closely annexed to all of the other discretionary items, which also dovetails into how they're getting some of those discretionary items. They're going out and bidding against for inventory that is Banana Republic even to try and get that into their stores. And they're able to discount that much more. And so all of that considered, and I didn't even get to the last thing, which is the more affluent consumer, just keep an eye on how they're showing up in the consumer confidence data as well going forward from here.
Yeah, certainly. Well, you made your first Costco trip recently, didn't you?
It blew my mind.
Yeah, you were very impressed.
I'm going back this weekend.
Are you?
That place is incredible.
Have you been to the
It's
liquor
like an
department
amusement
there?
park,
It's great.
man.
Yeah,
What?
really solid liquor department there. Most Costco's.
I have a feeling Dave
didn't-
visited it on his first trip. You
I
didn't?
actually didn't see it.
What? Wow, I never would have guessed that. You know, you never
We'll talk about that.
It's Uber order.
Surprise me. Brad, thanks so much. And also, a quick programming note, be sure to stick around for Yahoo Finances after the call, where Brad Smith and myself, we will be breaking down Costco's biggest takeaways from their earnings report and also the company's call. Don't miss that.
Brad Smith here with Shauna Smith. We've got your After the Call coming up, and this time we're talking about Yahoo Finance's 2022 Company of the Year is Costco, ladies and gents, boys and girls. Tune in after their earnings call ends, because that's when we begin discussing what the tenor and the vibe of the call was.
I will be watching any trade down or any commentary about their private label brand, Kirkland, one of my favorites. And also their membership fees, and talk about whether or not that will be raised.
I, like many other golfers out there, might be a fan of the Kirkland golf brand and the balls there, but at the end of the day, it's those discretionary categories that have been weakness for Walmart, for Target. Could it be Costco as well? Best thing you've ever bought from Costco?
One of the things I love from Costco, underrated, their socks.
Pesto butter salmon. Tune in, everyone. Brad Smith, Shauna Smith, we've got you covered after the call.
All right, well, now let's get you up to speed with Tesla. Another big story of the day. Shares are under pressure in the final hour of trading. We're looking at losses of just about 6.5%. The move lower, looking like investors were left pretty unimpressed by Elon Musk and company at its investor day yesterday afternoon. Dan Ives, Wedbush Managing Director, Senior Equity Analyst, joining us now here with more. And Dan, it was a pretty long presentation, about 4 hours. Some criticism just in the fact that we got this grand Tesla vision, but it lacked details. You don't seem to be concerned about that. Why?
I think that's always the narrative coming out of these events. I'd say the same for Apple. I think what they really did was they laid out the foundation to drive costs down 30, 40, 50%. And that's going to ultimately enable them to have a lower price vehicle, which I think is really the important thing. I ultimately viewed it as a flex the muscles moment for Tesla, but it just comes down to these events, knee-jerk sell-offs. We'd be buyers on it. That's how we've been telling our investors.
How essential, Dan, is that under $30,000 Tesla model for the investor story moving forward?
It's the hearts and lungs to get to mass market. In other words, when you have $60,000, $70,000 cars, okay, you could sell 2, 3 million, but you're never going to get to annual 4, 5, 10 million when you're selling at those price points. That's why sub 30K is so important, especially right now as part of this green tidal wave in terms of electric vehicles. Tesla, it's their world, everyone else is paying rent. So this is the opportunity now to put that iron fence around their install base. And that's essentially what they're doing. They're laying the groundwork. But of course, coming out of the event, investors, Wall Street, they want more meat on the bone.
Dan, I got to tell you, I love all of your one-liners. It's hard to keep up with all of them. They're the best. We talk about it all the time. But Dan, what do you make of the reaction that we're seeing in the stock today? I know you were saying you weren't too concerned about anything or maybe lack of detail that we got out of the investor event yesterday. But do you think that's just simply a result of the fact that Tesla is up so much since the start of the year?
Exactly. I'd say, and again, first off, happy birthday.
Thank
so
you.
I would say so I think this is just a sell on the news, in terms of maybe some anticipation going into it. But if you read the tea leaves, I mean, Musk is essentially laying out that they're going to be able to lower costs 40, 50%. Look at this neighborhood. Look at Rivian. I mean, that's been a dog eat the homework situation every quarter. Then you look at Ford and others. I mean, it just shows Tesla's in a very, very strong position. I think that's sort of our takeaway.
We did see some actual video of the Cybertruck, although again, vague promises from Mr. Musk in terms of when we can actually expect it. How much were you moved at all by seeing the truck? And do you think, how much of this is part of your price target?
Well, I mean, we don't really have too much factored in to our numbers. I mean, if you look at Cybertruck going in 2024, I think it's going to be revolutionary. I mean, it's our estimate you have over 1 million pre-orders. Even if you cut that by 30, 40%, this is going to be massive. I mean, I think a year from now, you're driving around Manhattan outside your studios and you see Cybertrucks. And I think this just ultimately sends that path where you're going to have Tesla expanding more and more of their model line now that they have the scale and the scope globally.
At what price point does Dan Ives buy that hideous looking vehicle?
Well, I'm on that pre-order list
You are?
myself. So if you see a Cybertruck in New Jersey about a year from now, could be me. But look, I'm just a believer. Again, it's a people hate it, others love it. Mad Max. I just view this as sort of a revolutionary design that I think is going to, ultimately be attracted by many Tesla loyalists.
It's the cilantro of automobiles. There's no gray area.
There is certainly no
That may
gray
have been
area.
a really strange
Exactly.
comparison.
Dan, did you want to know anything?
If you pull up to a Costco parking lot in that a year from now, you're going to be able to put a lot of stuff in that back.
Okay, there we go. One compelling key
that's the
sent to
video I
get
need,
it.
man.
I know, exactly. There we go. We're intertwining all the big stories of the day. Dan, let's talk about Succession, because lots of questions, or I think a lot of people wanted to hear a little bit more about Succession from Elon Musk. He had a number of his executives up on stage with him. How are you viewing all this talk about Succession and what Tesla might potentially look like 5, 10, 15, 20 years from now?
Look, I think Musk is CEO of Tesla at least through 2030. So, I mean, Succession, you had Tom Zhu, you had others. That was sort of a show of force, to show it's not just Musk. But ultimately, look, Musk is the hearts and lungs of Tesla. It's part of how we are where we are today in terms of what I view as, along with Apple, the most transformational company in the market. But I think this was really showing that there's not a revolving door. You have a bench, and you're starting to see that now play out. But in terms of as a CEO, I believe Musk is going to be CEO of Tesla between at least till 2030.
Elon does not appear too concerned about a J.D. Power releasing its annual customer satisfaction rating, which Rivian dethroned Tesla in the EV category. What are your thoughts on Rivian's future and their cash position?
It's a frustrating one because, just like you said, I think what Arjun built, the product, the category, it's game changing. The problem is you have to be able to produce the vehicles, and that's been their Achilles heel. And it's sort of been one thing after another. I believe they're starting to fix it, but they need to scale over the next 9, 12 months. That's sort of the key. And it's not a zero-sum game. You're going to have a lot of benefits as part of this green tidal wave, including, many in the 313 area could, where I believe GM is going to see a renaissance of growth.
All right, Dan Ives, you got to leave it there. I got to tell you, I'm excited to maybe see you behind the wheel of a Cybertruck pretty soon at Costco.
Oh,
better follow through.
At Costco.
It's going to be awesome.
There you go. Easy. All right, Dan Ives, great to have you. Thanks so much. Well, we are just getting started here on Yahoo Finance Live. Coming up, the future of Disney, Citi making the case that the company could trade Hulu to Comcast for Hulk. More on that coming up. Then Salesforce facing mounting pressure, activists circling the company over an unprecedented battle, clamoring for better profit margins. We'll break down what lies ahead for that company. And the retail earnings keep rolling in. Nordstrom, Costco, both reporting after the bell. We'll bring you those numbers as soon as they break. Don't go anywhere.
We've been hearing an awful lot from the Fed this week, with a number of presidents weighing in on what's next for the central bank's battle with inflation. For the latest, we turn to Yahoo Finance Fed reporter Jen Schomburger. Jen, what's the latest?
Good afternoon, Dave. Atlanta Fed President Raphael Bostic says he's going to stay open to the possibility that if the data come in stronger than expected, the case could be made for higher interest rates than previously expected. Bostic, speaking with reporters on a call this afternoon, said, quote, "There is the case that could be made that we need to go higher. Consumer spending is strong and labor markets remain quite tight, and those suggest that the economy's strength could be a bit more than people think, which means we might need to do more." Now, these comments come after Bostic wrote in an essay Wednesday that he believes the Fed needs to raise its policy rate by 50 basis points to a range of 5 to 5.25% and hold it at that level well into 2024. Though Bostic said he wouldn't firmly commit to a policy rate until the meeting on March 21st and 22nd. He also said he's firmly in the camp of moving in quarter-point increments. Bostic also told me he expects the Fed would be in a position by mid to late summer to pause rate hikes, and once they do, they should hold and not have policy bounce around. Now, Bostic's comments come after Minneapolis Fed President Neel Kashkari said Wednesday that he's open-minded about whether to raise by 25 or 50 basis points at the next meeting. He said he thinks it's more important that the Fed signals how much higher it intends to raise rates, that so-called dot plot. Kashkari says he'd lean towards continuing to raise rates further than the 5.4% he projected back in December. Now, Kashkari will participate in a radio interview this evening at 6 p.m. on the economy, justice, and race. We'll also hear from Fed Governor Chris Waller at 4 p.m. on his economic outlook. Guys?
Yeah, Jen, when you take a look at the market's reaction today, it looks like investors are trying to shake off those concerns about higher rates. What do you think the market is expecting from the Fed next meeting, given the rhetoric that we've heard from the Fed over the last several days?
Shauna, I think that the Fed is still going to continue to move in 25 basis point increments. They want to remain cautious. They've done a lot of work over the past year, and they're finally getting into this period of time after raising for 8 to 10 months where they're going to start to see the bite of that monetary policy start to kick in. So they want to walk that tightrope of still bringing inflation down, but not crashing the economy. And so that's why I think you'll continue to move them. You continue to see them move in slower increments. Having said that, we have seen some higher inflation reports as of late, certainly that blowout jobs report we got. We're going to get another jobs report next Friday. Officials are going to take all of this into account when they look to how high they're ultimately going to raise their policy rate. And I wouldn't be surprised, given the comments that we've seen over the past couple of weeks, that they may move it up just a bit. Right now, they're looking at about 5 to 5.25, which is where Bostic falls. Maybe we see it inch up a little bit from here, guys.
Can't help but wonder another 500,000 jobs created will change the thought process there. Jen Schomburger, thanks so much. Appreciate that. Before we head to a break, let's take a look at the 10-year yield, still above 4%. We'll break down what this means for your investment portfolio next.
Welcome back to Yahoo Finance. U.S. Treasury yields are soaring. Take a look at the 10-year yield, getting a lot of attention this week, breaking back above 4%. Joining us now for more on that, we want to bring in TheoTrade Chief Market Technician Jeff Bierman. Jeff, great to have you again. So you look at this from a technical perspective. We're back above that 4% threshold. What do you think the bond market is signaling to you? And what do you think that means just in terms of the trading action we could potentially see?
Well, there's this fulcrum going on between the Fed raising rates and the Fed, people thinking the Fed's going to hold off rates. And I am more leaning towards what the bond market says than the narrative that comes out from the Fed weekly. I just go by the facts, Shauna, and the facts are labor markets are tight, prices are not coming down. We've stabilized. We've come from an 8.5 handle on the inflation rate on the CPI and PPI to about 6, but we bounced back up. So we overshot to the upside. We've stabilized here somewhere between 5, maybe 7% for the time being. And I don't think that fits with the Fed's mandate of that 2%. So the bond market is taking the lead away from the Fed and saying, listen, we're just going to ratchet up rates just in case here. And even if there's a 50 basis point hike that's baked in, the Fed funds futures rate that's priced in is telling you 475. So if we're at a 4 handle now, you may actually see us go up another 75 basis points before we pause once again. But don't think just because we pause, we're going to pivot. We may stay there for a lot longer than most people suspect.
Yeah, we heard Kashkari well into 24 was his guidance there. You mentioned the 10-year there. Any different indicators when it comes to the 2-year now pushing 4.9?
Yeah, here, listen, Dave, look at the 10 against the 2. That's the benchmark that the Fed looks at. Now, I look at the 10 against the 30. That's just me because I look longer term. But the 2 is accelerating at a faster pace on the yield than the 10. Definition, translation, you're in an inverted yield curve, which signals a recession, and we're accelerating into that recession because the delta or the divide between the 2 and the 10 is getting wider and wider by the day. That's why the market's on its heels. It's backing off because it's saying, are we in a recession? Are we not? We're accelerating faster into one based upon the inverted yield curve. That's what I'm seeing.
So, Jeff, what does that mean for portfolio allocation? Should investors be allocating more towards bonds? And that 60-40 that we all know so well hasn't really necessarily been working last year. But should that new narrative be maybe 40-60 in favor of bonds?
You actually might want to up the ante on that, Shauna. The 60-40 is the traditional model portfolio of 60% equity concentration, 40% fixed income. But if you're getting a 4 to a 5 handle on a fixed income product that has half as much standard deviation or even half as much systematic beta as, let's say, the stocks, now you're competing for a yield that offers you twice as much, actually almost 3 times as much as the S&P 500 with half the risk. So the mean variance criterion is to simply get the highest yield at the lowest possible risk or maintain the lowest possible risk that offers you the highest yields. And so bonds are now standing you, looking in their face, begging you to buy them. And I think that's a good move. I think investors should actually start to up the ante on perhaps even 55-45, simply because if we take out 3,800, you won't have a hedge to the downside once interest rates start moving up. And so I think investors should start to overweight into bonds right now until we get the all clear signal that the Fed is done raising rates, and we're not even close.
Wow, buckle up. Okay, before we let you go, we understand you have something significant to point out when overlaying hospitality giant Hyatt and biopharma giant Pfizer. What are you seeing, Jeff?
Dave, this is the Seinfeld market. It's the Seinfeld market. If we're going into recession, what's the playbook, everybody? You got to rotate to low beta, defensive stocks with high yields to kind of fight off the downdraft. What's happening here is just the opposite. This is what I call investors who are in the bizarro world. It's the Seinfeld world. They don't even know what they're doing. They're just, hey, let's chase Hyatt all the way up. And if we're going to recession, what makes people think that Hyatt is going to be the beneficiary of recession? And let's shun and avoid Pfizer altogether, with an 8 PE multiple, a 4% yield, and cash flow that, defends in a recession. So like I said, this bifurcation is telling me that investors are chasing performance both up and down and doing very little research. And that type of confusion is being played out because of the narrative that the Fed's kind of hemming and hawing day in and day out. So until value stocks start to make a comeback, and until these growth stocks, which are in the leadership of the markets, leisure and airlines, we don't have a market that has any type of what I call like basis to move that much higher until the financials, technology, and industrials take the lead, which they're not.
It is essentially George Costanza telling a woman, my name is George, I'm unemployed, and I live with my parents. And it worked, Jeff. It's that Seinfeld market. You are a genius. Jeff Bierman, appreciate it, brother.
Thank you, Dave Shankson. Take care.
All right, coming up, one analyst sees Disney shedding off some of its Hulu stake for 2 Marvel characters. We'll tell you all the details next.
All right, time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We got AB InBev, Disney, and Six Flags. My pick is the world's largest brewer, Anheuser-Busch, here, erasing an earlier decline. You can see trading higher by just about 1% after its recent quarter was met with pretty mixed reaction from the street. So the bears focused on that drop in volume that we just heard from AB InBev. It's first since the early days of the pandemic. Now, on the other hand, many of the bulls were encouraged by a surprise dividend raise and also a profit beat. Citi, which has a buy rating on the stock, saw the results as solid with profit topping expectations. On the other hand, RBC called the print, quote, not great, writing in a note to clients that we hope this is a note that this is no more than a speed bump on AB InBev's road to rehabilitation. So certainly some mixed reaction from the street, but at least for today, trading to the upside. But I think this begs the question about whether or not a name like AB InBev, if it's recession proof, if it's able to ride out some of that economic uncertainty. And I think initially the argument was yes, they should be okay. But I think this latest report really shows that consumers are pulling back, especially here in the U.S.
And I do think it's encouraging the fact that the price increases did offset the decline in sales, because we've heard from Walmart, Target, even Macy's this morning that consumer behavior patterns, they're shifting. They're pulling away from discretionary spending. They're leaning towards more essentials. Now, I guess you could argue that booze alcohol. That might be an essential purchase.
In COVID,
not
I
so
think
much,
that's
not so much a
shift.
discretionary purchase, but the company did say they blamed it largely on a drag in China due to COVID. So I guess we'll see in the coming quarters if they can recover some of those sales.
Where they are recovering sales is in the non-alcoholic category, and it's an odd consequence, I think, of the World Cup issue they had with Qatar. You remember they couldn't sell Budweiser. They could sell Budweiser Zero, and they said it was the #1 non-alcoholic beer in the world in the fourth quarter. Bud Zero, just a continued winner for Budweiser, double-digit growth in the quarter, and that is the largest growth area across all beer
That's
at the
surprising
moment.
to me that Bud Zero would be the top seller.
That's their winner right now at Bud.
Well, I'm not drinking. When I drink around the world at Epcot, I enjoy that. That's my triple play today. Rough transition there. Disney. Citi analyst Jason Bazinet out with a new note suggesting Disney may want to sell its stake in Hulu after Bob Iger said the company is less focused on general entertainment content. Bazinet did suggest that Disney could leverage the sale to secure the rights of 2 Marvel characters, Hulk and Namor, which are currently controlled by Comcast. The analyst said Hulu's price tag could range anywhere from $19.8 billion to $27.5 billion. Comcast currently owns a 33% stake in Hulu, with Disney controlling the rest. So guys, I'm curious what you make of this. Bazinet does have a buy rating on Disney, and he did suggest that this could maybe be a win-win for both companies.
I think so. And Brian Roberts said back in September, if in fact they are for sale, he does want to buy out the remaining portion. He called it a phenomenal asset. My only caution with this strategy of Iger is look what happened with Ant-Man last weekend. It made $32 million. It was #1. It was the largest decline in week 2 in Marvel history. And the question is, are we getting sick and tired of Marvel characters? I don't know if the film was great. I didn't see it. But a 70% drop off in 1 week tells you maybe there is a point at which those franchises don't sell so well after the first week.
Yeah, and I also think that another concern here for Disney, if in fact they do decide to sell their stake in Hulu, is some of the caution out there on the street that maybe they could actually see a reduction in subscribers because of that bundle package that they do have right now with Hulu, ESPN Plus, and Disney Plus. If they no longer have Hulu, maybe some people then will also cut Disney Plus and ESPN Plus just because they simply don't see the value of those as standalones, given the prices that we are seeing and how much people are paying really across the board in subscriptions now.
Boy, Iger's got his hand full. From Disney to Six Flags, which is my play. Shares have fittingly been on a roller coaster ride over the last year, but on the upswing today after reporting their earnings. The stock, you can see, up almost 6% today, despite reporting attendance dropped 26% last year from the prior year. Six Flags revenue dropped 9% for the year, despite a 22% increase in average guest spending, which was driven by higher admission and in-park spending per capita. Said their CEO, quote, "We are pleased to have delivered record fourth quarter adjusted EBITDA, which provides evidence that our new strategy and new culture are beginning to take hold." Now, part of that new culture involves headcount reduction and employees working less. Is this a model for long-term success? Fewer visitors, spending more money. That's a steep drop-off, 26% decline in people coming through the turnstiles.
A very steep drop-off, and also a very difficult time to really see such a drop-off and raise their prices by so much, given the fact that consumers are paying more for almost every aspect of their life right now because of inflation. It's interesting some of these changes that the company are doing. You mentioned that they're just in terms of their turnaround plan, investing in these parks. They also have VIP lounges. It was something that they did tout on the call. Once again, a VIP lounge at Six Flags. I don't exactly know what that would look like and if that's going to be enough to get people to visit their parks, but it's one of these points that they keep going back to time and time again. But I think given the fact that when consumers are spending, they're spending on experiences, and Six Flags still seeing that drop is a little bit worrisome here.
Yeah, I personally love Six Flags. I always have a good time whenever I go there. I think the key phrase on the earnings call was course correction. Management did guide to more optimism in 2023, and I think that's why shares are higher today. But we did hear from James Hardiman from Citi this morning. He said for him, this is a show me story. They want to grow attendance by double digits. How do you get there? We need to see those results in the coming quarters.
CFRA upgraded the stock on the earnings report.
I know, yeah, and the result of the estimates were lowered by so much. There was some mixed reaction there on the street about these most recent quarters. Okay, well, coming up next, Salesforce winning back Wall Street, at least for now. The company posting a surprise earnings beat in the fourth quarter. Shares up just about 11%. We'll talk to one analyst who's bullish on the stock despite pressure from activist investors. Next.
Shares of Salesforce have surged since the software giant released its fourth quarter earnings Wednesday, despite the growing influence from a slate of activist investors, including Elliott Management, who has nominated a number of candidates to the company's board, a prospect that CEO Mark Benioff told Yahoo Finance executive editor Brian Sozzi that he is keeping an open mind about.
The activist situation, I have never seen anything like this. What is there a resolution in sight? How does this all end, and how do you move beyond it?
Well, look, I can really learn from anyone, and I enjoy meeting new people, and I enjoy talking to folks. And look, there's lots of different levels of understanding of enterprise software. There's different understandings of our company, who our customers are. But it doesn't matter what grade all these folks are at. I'm trying to ingest and learn and understand their perspectives. I think it's extremely important that I have a beginner's mind. I like to practice the Japanese concept of shoshin. How do I have a beginner's mind? In the expert's mind, Brian, there's no possibilities. The beginner's mind, there's every possibility. And that is really my approach with everything that has been going on with Salesforce. And it's been great. And then out of that, wow, I was just really blown away with Mason Morfit and how he was able to just, grok what we're doing at Salesforce, but then deliver these, like I said, these decks, which outlined what we thought was just strategic directions for our company that really showed his expertise. And that's why we've added him onto our board.
Mark, you really, you've long been seen as a pioneer in software, but also in the business community. And you're a co-founder of this really large company. How has this been to go through a situation like this?
I'm having the time of my life. I mean, this has been 24 years. You've been along the way for a long time too. You've been to all our events. You've talked to so many of our customers and our employees. And look, this is great. Who would have thought, 24 years ago when I was a few blocks away from here at the top of Telegraph Hill in an apartment overlooking Mount Diablo, before it had all this gorgeous snow covering that it has today, I would say we could never have imagined that we would have delivered, one of the very largest and most important software companies in the world. I'm very grateful to everyone who's been part of this journey, and I couldn't be happier with where we are today and where we're going.
Outstanding interview. All right, joining us now to discuss the growing influence of activists is Constellation Research Principal Analyst and Founder Ray Wang. Ray, good to see you, sir. I love that Shoshin, the beginner's mind stuff, but is Mr. Benioff really grateful and thankful for all the input of these activist investors? Because that's what I'm hearing there.
You know what, Mark is a great individual and leader in terms of being able to take different perspectives. I think he's making the best of what's going on out there. In the case of, that investor, I think they did provide some good value there. But a lot of these investors are what we call vulture investor firms, and they don't add value. And they're just designed to actually arbitrage the stock price. And that's when it becomes dangerous. That usually happens. It makes sense when you have a company that's in decline. They're no longer in growth mode. Salesforce is not one of those companies. In fact, Salesforce is a company that is in growth mode, and that's what made this attack seem very unusual.
So, Ray, why do you think sometimes they do more harm than good, and the risk there of leaving potentially the company more damaged than it was before these activist investors got involved?
Well, I'll take an example right now. In Salesforce, they disbanded the M&A committee, right? And they're going to put $20 billion back in stock buybacks. Now, granted that Salesforce has gotten to a point where they are one of the top, and if not only the number one enterprise software company in the world, but they can still make additional acquisitions. They can use that funding and acquisitions to help them, in terms of improving and taking themselves to the next level. You looked at companies that haven't done that in the future and they can't make those types of acquisitions. Returning money back to shareholders is the worst thing you can do if you're trying to grow your company. And if especially you're a founder-led company like Mark's, that's one of the things where you try to avoid. But there are things that also need some structure, like costs are out of control. Sales, marketing expenses are probably on the high end. And that's where PE firms and vulture capitalists come into play.
You don't seem to have the same reaction as investors do. The stock up more than 11, almost 12% on the day. You don't seem to be as embracing of those results as investors. Why?
Well, they blew their sales numbers out of the water, right? And they were probably going to do that anyways. And so, being able to actually come in at those, come in at the rate that they came in, people knew that they had a good quarter. They didn't know how good of a quarter. The activist cloud actually was what was driving down the stock price. They are still down from their highs, right? But, we have a price target of them, in the 200 range, right? But that's, we expected that. But the activist cloud was really what was clouding the message.
Right, when you take a look at these activist activity and numbers here, 36% jump in 2022 compared to 2021. There was 235 activist campaigns here. Technology, the tech sector was the most frequently targeted sector. What do you make of that trend, the opportunistic, thinking here amongst activist investors when it comes to tech? And do you think that trend is going to continue this year?
I think it's going to continue. You follow the capital flows and you look at the amount of money that PE firms like Thoma Bravo have raised, right? And Vista Equity have in their funds. There has to be an exit somewhere and there has to be a beginning somewhere. And there's someone always at the end of the deal. For the vulture capitalists, there is someone at the end of the deal. And it's been these PE firms that are willing to take a company back when they're actually battered, take them down, fix them, and then say, hey, look, instead of focusing on 17 different things, you should focus on 7 things and, concentrate your activities here. And that's usually what those firms do. They have a playbook. They put that playbook into play. And of course, the companies become profitable, but they no longer are seen as leaders. It is very rare for a company taken over by any of those firms to come back as a leader in their space. Look at Citrix. It's no longer a leader. You look at what's happening in, what happened to Informatica, no longer seen as a leader in the space. All these companies are taking hits. SAP got hit by Elliott Management, same kind of challenge. They don't have the capital or can't put the capital to put into R&D for them to actually come out of the spin that they're in.
Certainly been amazing to watch the uptick here in activity. Ray Wang, thanks so much.
Take care.
All right, well, coming up, the rich are only getting richer. When we come back, we'll tell you who is topping one group's list of America's most overpaid CEOs and why. We've got that for you after the break.
CNN has not been number one in a long, long time, but their boss is on top today. Nonprofit group As You Sow, they annually compile a list of the most overpaid CEOs, and coming in at number one is WBD's David Zaslav, the Warner Brothers boss. His comp package, nearly $250 million, despite regaining more than 50% on shares this year. They're down more than 40% over the last 12 months and still making $250 million. Rounding out the top five, Estee Lauder's CEO Fabrizio Freda, Penn Gaming, Jay Snowden, Intel's Pat Gelsinger, and Booking CEO Glenn Fogel. Notable names among the top 10 include Amazon's Andy Jassy at number 9 and Apple's Tim Cook, who takes the 10 spot. The average pay of the 100 most overpaid CEOs was more than $38 million. That's up 30% in just 1 year, just slightly more than inflation, if you will. How do we average Joes compare to the big bosses? Well, you might want to put your earmuffs on. The AFL-CIO reports the S&P CEOs made 324 times more than their median paid worker, and all the boxes on your front porch, well, they push that ratio to 6,474 to 1 at Amazon. To be clear, I'm not begrudging anybody getting that green. We celebrate that here at Yahoo Finance when you've earned it. In the sports world, QBs and coaches get the credit when their team wins and the blame when they lose, but far too often in big business, at least in the last year, businesses don't work that way. As You Sow's Rosanna Landis said this: if a company has a good year, it's all about the management team and the CEO driving it. If they don't do well, it's all about external factors. She nailed it there. There is a glimmer of hope, though. Shareholder votes against CEO pay continued to increase to nearly 13% in 2022. And as we've talked about, activist shareholders becoming far more prevalent, and they will continue to put pressure on compensation for CEOs. Now, any day now, we could get a ruling from a Delaware Chancery Court on Elon Musk's mind-blowing pay package. It's worth more than $50 billion. All I'm calling for is the same thing I ask of my children, and it's a little accountability. When you screw up, there ought to be some consequences. Yes, the rich are getting richer, and that's cool. But when you're having a terrible year, you don't deserve to make that huge cash, and that continues to rub the American public the wrong way. We went through this after the financial crisis, and then it just kind of went away.
Yeah.
And now it's back.
Yeah, I think it does. It rubs the American public the wrong way. It rubs the employees, I would imagine, the wrong way. Employees want their leaders, want the executive team to take ownership, to take leadership, to really own what is going on at the company. We certainly, I don't think we have seen that in many of those companies, given what you were just outlining there, the discrepancy in terms of CEO pay versus what the employees are getting paid. But one CEO, though, that did take accountability was the Zoom CEO, Eric Yuan. He's taking a pay cut, Dave, of 98%. His salary this year is going to be just $10,000. He's blaming the issues that the company is certainly have had over the last several quarters. Some of the fact that they have laid off a number of employees too. He's saying that that is a result of mistakes that he has made, and as a result, he's taking accountability.
Bravo.
And cutting that pay. So maybe we'll see more chief executives following suit. I wouldn't hold our breath, though.
Tim Cook took a pay cut, but that was largely seen as a move because the board was getting to the increase in vote against his compensation package. More accountability. Coming up, we're counting down to the closing bell on Wall Street. Stay with us right here on Yahoo Finance Live. All right, just a couple of minutes away from the closing bell. That's when we bring in Yahoo Finance's Jared Blickery to break down the market action. Didn't start the month so well. How are we doing today?
Not too bad, not too shabby. Dow is up 1%. That is, last time I checked, good for the second best day of the year. Been up and away since the 2 p.m. hour. And let's check out the other one. S&P 500 and Nasdaq each up about 0.7%. Russell 2000, small caps are lagging a little bit. They're up about 0.2%. Now, in terms of market leadership here, only consumer discretionary and financials are in the red. Utilities, staples, and real estate, those are all leading up over 1%. Kind of a defensive setup. Interestingly, tech is up 1% too. So is industrials and materials. Now, let me switch over to the bond market for a second with less than a minute to go. Bond market closed at 3 p.m., but I got to show you the 10-year up another 8 basis points to the highest level since what? Since last November. So we're going to see potentially this high right here in the 10-year eclipsed, and that would be an incredible statement about what the Federal Reserve is doing. Should also add that the 6-month T-note yield surpassed 5% today. So let's take a look at what's happening inside the Nasdaq. Got some nice green on the screen here, despite those surging interest rates. Look at that, Microsoft, Alphabet, each up more than 1%. Just a couple seconds ago, Tesla down 5%. Here's your closing bell.
All right, that does it for today's trading day. All three of the major averages closing in the green. You're looking at the Dow closing up just about 343 points, S&P up about 0.7%, as well as the Nasdaq in terms of the sector action today. Consumer staples among the outperformers, along with technology, real estate, utilities. Only underperformers, the only sectors closing to the downside today, consumer discretionary and financials. All right, let's talk about one of the big movers of the day, one of the big stories, and that's Macy's. Shares skyrocketing here, closing up just about 11% after reporting better than feared earnings results. But the retailer did highlight some areas of growth here, specifically in the luxury consumer, with spend within the Loyalist program at Bloomingdale's rising 7%. Here's what CEO Jeff Gennette had to say about the trends that he's seeing on today's earnings call.
When you think about share of wallet, we have opportunity to capture more, and particularly that top of the list. And that luxury consumer, they're really spending where there's scarcity and where there's specialness.
So Macy's going to rely on that luxury consumer, the higher end consumer, it looks like, at least over the next several months, days, because when you dig down into these results, clearly Bloomingdale's and Bluemercury were the outperformers here.
Yeah, we have continued to notice a trend with makeup, and Bluemercury saw sales increase 7.2% in the quarter. We saw that with Target. We've seen it with other retailers. Is it becoming essential? I mean, it appears to be that way. And I think we saw that trend start to tip in the midst of COVID. Now, we can't help but wonder that leaning into the luxury consumer. What does that mean as we turn the page here shortly to Nordstrom earnings? Will they see a solid report based on that similar shift? You sure would think that we would see a similar lesson learned. Now, I also want to point out one other thing Gennette said when he said that the company was competitive but measured in our promotions. He says they took strategic markdowns, intentionally did not chase unprofitable sales. And it sounds like he's talking about Kohl's. So Macy's margins fell just 2 percentage points. Kohl's fell 10% in terms of their margins. So those who do chase those sales, we saw that with Dick's Sporting Goods as well, are paying for it in their quarterly earnings.
Yeah, they certainly are paying for it. It's also important to put these results in perspective here, because remember, Macy's warned not too long ago, it was in January, that their holiday numbers were going to disappoint. We saw that reflected in the stock price at that time. So yes, we are seeing a big jump today, but a lot of the, not too hot results that we did get this morning have already been priced in, because when you take a look at total same-store sales, that key metric here for any retailer, but specifically for Macy's, falling 2.7%. Sales at its namesake brand, Macy's, falling just about 3% here. So I think a lot of that was better than feared, at least, and that's why we're seeing those shares rise today. In terms of the street's reaction, they were actually pretty pleased with these results. Dana Telsey over at Telsey saying that it was a nice Q4 beat and really saying that management deserves credit for operational discipline in a very volatile macro environment, which I also think points to the point that you were just making about the promotional activity and really holding back on some of those discounts.
It's a great point, because this is terrific operations. I think you could even say a similar thing about Best Buy. We knew the electronics market was devastating, televisions, whatnot. They seem to operate through a bad environment, and you're certainly seeing that here with Macy's, although the guidance don't look great. A lot of the retailers we're hearing warn about some choppy times to come. They think sales could fall around 3% in 2023. So could be a bumpy road, but the way they're operating, they might just be fine.
It might be all right. All right, well, let's take a look at another big story, another big mover today, and that is Ford. Shares closing up just about 2% as the company announces it is restarting F-150 Lightning production. Our Pras Subramanian is here to discuss. Pras, obviously good news here for Ford.
Welcome news for Ford. Yeah, restarting that production after almost a month off there for the F-150. We heard about that stoppage on Valentine's Day, actually, but it actually stopped a week before that. So good news there. They're allowing their battery supplier SK On to sort of ramp up new cells and new, they build them into a pack to put them into the car. So they're giving them time to do that. But they're going to continue to hold back the produced vehicles, even the ones they're building right now, to work through some updates that they're doing. So not out of the woods yet, but still welcome news that in a week or in about 10 days time, they'll be restarting production of that.
That is big news for them. A lot of bets on that, and the shares up just less than 2%. Now, Ford also out with February sales. Anything stand out to you in that regard?
Yeah, and a good month for, welcome news again here. Good month for Ford after some struggles at the end of the year. Sales up there 22% from a year ago there. Improvements, it seems, with part shortages sort of alleviating there. Big moves here for the F-150 up 10,000 compared to a year ago. The Explorer up 10,000 units compared to a year ago. I know, that surprised me too. And the Bronco, of course, up about 7,000 versus a year ago. So good stuff there for them from that point of view. But, you know, those Lightnings, they sold about 1,300 Lightnings last month. March is going to be really light. So that's going to be a tough month for them in terms of production there. So that'll be a bad thing for them. But, you know, it seems like the other cars, the ICE-powered gas cars, are improving for them.
Yeah, the Explorer shocked me, man. I mean, it's just a vehicle you haven't heard much about. The Bronco you hear about constantly. People are just paying to move up in the line for a Bronco. That is a hot car. Look at that thing. I want to get one of those. I might want one of those more than the Ford F-150 Lightning.
Wow, that says something.
That thing right there is awesome. All right, Pras, you also sat down with the Polestar CEO after earnings. Biggest takeaway there?
Well, you know, you guys just talk about luxury, right? Polestar is a luxury brand, and they had a nice quarter. Narrower loss than expected, which is good to hear, and revenue up 80%. But the big thing was they hit their production forecast, 50,000 cars this year. We spoke to the CEO, Thomas Ingenlath, earlier today. Here's what he had to say about that.
We had a very, very strong production run in the second half of 22, which then left it up to our countries to deliver these cars right to the last day in 22 in order to get really all the produced cars out. And you can imagine we had a very, very happy Christmas party, knowing that we are in the run for delivering and really making that distinction, really being the EV startup that delivers on the targets.
So yeah, they delivered on that target, and for 2023, they see deliveries going up to 80,000 units. So, you know, you don't see that happening much with EV pure play startups. They're usually missing these targets, but they're actually hitting them and they're actually going to expand for next year. So good news there for Polestar.
Yeah, Rivian, for example. Polestar, are they planning on expanding that lineup in the years ahead?
Yeah, most importantly, this year, the Polestar 3 SUV comes out back half of the year, and the Polestar 4, which is more of a sportier SUV, comes out later this year. So 2 new cars this year at the end of the year. So they're going to round out that portfolio, and then probably 2024 will be a big year for them from like a big sales point of view.
That's really solid progress from Polestar. Pras Subramanian, good stuff. Thank you, my friend. All right, from autos to housing we go. Mortgage rates are creeping higher and higher thanks to soaring Treasury yields. We talked about the 10-year earlier, continuing to move to the upside. Fresh data from Freddie Mac revealing that 30-year rates have climbed from 6.5 to 6.665 in the past week. 15-year rates inching closer to 6% over the time frame. Joining us now to break this down, Yahoo finance reporter Danny Romero. Danny, this is This is feeling a little scary because people thought those rates were going to start to tick down to 5. Instead, it looks like we're heading up to 7. And I just read earlier today, Mortgage News Daily has them north at 7. Where are we headed?
Yeah, so mortgage rates are bouncing up once again, closer to that 7%. I mean, Freddie Mac, like we said, says that the 30-year fixed mortgage rate is up to 6.65% from 6.5% from the week before. And that's really crushing home buying activity, for the moment. Rates have climbed about 0.5 point in February, really reversing what we saw in November. And so the spike in rates is really just another blow to home buyers who are really facing higher home prices as well as a shortage in affordable homes. And so home buying demand just hit a 28-year low, which is really signaling that affordability is still a top concern for home buyers. And so home prices, like I said, are still high. The median listing price is about $415,000, and that's slightly up from January's figure of $406,000. That's what Realtor.com says. But the monthly mortgage rate is still 45% more than it was a year ago. And so not only are home buyers being impacted, but so are sellers. Sellers are saying, yeah, I'm not going to list my home. I'm sitting on a really nice mortgage rate right now, so why would I go back into the market? Or, another thing is that instead of cutting their prices if they have listed their home, they're saying, you know what, we're just going to remove the listing. So the housing market recovery is really being stalled right now.
Yeah, no one's going to trade that 3 for something 665. And it's certainly when that appears to be headed towards 7. And first-time home buyers just entirely priced down at the moment. So that's hurting. All right, some new data from the National Association of Realtors also reveals the racial home ownership gap has widened in the past decade. What can you tell us?
Yeah, so the racial homeownership gap is a very real and very significant issue in the U.S. And Black households are still lagging behind from other ethnic groups. About 44% of Black households owned a home at the end of 2021, and that's only up 0.4% from the last decade. And the reason is that 30% of Black households actually spend that 30% on their housing. And so, for example, in Wyoming, the average income for a Black household is about $60,000. That was in 2021. But, Black Americans aren't the only ones facing these headwinds. Hispanics are also facing very similar issues. The rate of homeownership sits between 27 and 67% nationwide. And for Asian Americans, 23 states offer homeownership rate higher than the national rate of 63%. But even white households are facing the same issues too. Homeownership rate ranges between 50 to 80%. And, Delaware, Mississippi, South Carolina, they're really leading the charge there. But I want to point out that to, narrow the gap, experts say that we need to add more housing inventory to the market and make it more affordable for that middle income household. But, another side to this that we're seeing is that state leaders are pushing those incentives. I mean, Governor Hochul has a plan to add 800,000 homes within the last decade. So we are seeing initiatives to narrow that gap. All right, Danny, thanks so much. We want to get to some breaking news here. Nordstrom is out with its earnings report. You're looking at shares moving in extended trading here. A lot of that has to do with the guidance that we're getting out here from Nordstrom. A fiscal year adjusted EPS guidance for the full year, topping the street's expectations, coming in stronger than expected. Also some commentary in this earnings report that markdowns in the second half, yes, it did impact margins there, but they are better positioned for a stronger 2023 in terms of the full year revenue guidance. So they're expecting a decline between 4% and 6%. For the fourth quarter numbers here, a bit of a miss on both the top and bottom, at least for revenue here. Revenue coming in just a bit light, $4.32 billion. Estimate here was for $4.67 billion, so a slight miss there. Adjusted EPS though coming in line with the street's expectations at 74 cents. Lots of focus in this report on Nordstrom Rack sales, that coming in just below expectations, $1.25 billion. The estimate was for $1.28 billion. But we're looking at shares pop here in extended trading. That is because of the full year adjusted EPS guidance that we're getting here from Nordstrom, better than expected. And executives making some comments here in this report that Nordstrom is better positioned for a stronger 2023. All right, coming up, we will have more on these results. Again, shares moving higher after hours. We'll be right back. All right, let's take a look at Nordstrom. Shares up just about 1.5% here in after hours. The company's full year adjusted EPS guidance coming in at the high end of the range here, coming in better than expected. A big driver here in the after hours action. Revenue for its most recent quarter, for fourth quarter, coming in just shy of the street's estimates of $4.32 billion. Adjusted EPS in line with the street at 74 cents. Let's talk about it and what we could expect here from Nordstrom going forward. We have David Swartz. He's Morningstar's equity analyst. So, David, I know you've just had a few minutes here to look at this report, but what's your initial take?
It's pretty much in line with what we expected after the earlier announcement in January. So back in January, Nordstrom had told us that its fourth quarter sales are going to be light. It gave a holiday sales update, and it appears that January after that, pretty much progressed as expected. So the sales are pretty close to expected. It looks like the full line sales were a little bit lower than I expected, but Rack came in pretty much as I expected, although the quarter was certainly very poor for Rack with sales down 8%.
Yeah, that's where I was going to go with you. Surprising to see that 8%. What is the strategy moving forward with Rack?
That's very unclear because Nordstrom's management has actually changed the strategy at Rack a couple times in the last year or year and a half. There was talk at one time that Nordstrom would try to sell more or less expensive products at Rack. Then management seemed to believe that strategy did not work, and they kind of switched it up on the last report. And said that they're really going to focus on the key brands, which I think is really the strategy that will work for Rack, because the real benefit of shopping at Rack over a store like TJ Maxx or Ross is that Rack tends to have much nicer brands. people know when they go there that they're going to find brands that they will not normally find at other discount stores.
David, shares surged back in February after activist investor Ryan Cohen took a stake in the company. From your perspective, from an analyst perspective, how are you looking at that? Is that potentially good here for Nordstrom going forward, or could it be a distraction?
We've heard nothing about this Ryan Cohen story since that initial report, so I'm not sure what's going on, if anything. So far, it doesn't seem to have amounted to anything, but the company did announce today that they're winding down the Canadian operations. This is a surprise. This was also included in the earnings report, and this is certainly a reversal from the last several years when expansion in Canada was a big part of Nordstrom's strategy. I don't know if this has anything to do with Ryan Cohen at all, but it does indicate that Nordstrom's management is making some big changes in the strategy. And there have also been a lot of management changes at Nordstrom, not the Nordstrom brothers, of course, which run the company, but most of the managers below them have actually been replaced in the last year or so, including the chief merchandising officer just a couple months ago. So there have been a lot of changes at Nordstrom. I think activists like Ryan Cohen could bring in a lot more changes, but we'll have to see if that actually happens.
CEO Eric Nordstrom addressed that shutdown of the Canadian side. This will enable us to simplify our operations and further increase our focus on driving long-term profitable growth in our core U.S. business. David, you also cover Macy's. Is there a common thread when it comes to the consumer in these two Q4 reports?
It was a very difficult period for all apparel retailers, including both Macy's and Nordstrom. They were coming off a very strong year for a lot of apparel retail back in 2021. The comparisons to 2021 are very difficult. And so it was pretty likely that it was going to be a negative report. But, I think Macy's handled the market conditions better in 2022 than Nordstrom did, and certainly better than Kohl's and Gap and some others. I don't know that you can say too much at this point, except that expectations are low for the first half of 2023.
Yeah, could be some tough times ahead. David Schwartz, Morningstar equity analyst. Great to have you, sir. Appreciate that very much. All right, let's get to Ali Canal with some breaking earnings reports when it comes to Costco. Hello, my friend.
Hi, Costco trading slightly to the downside right now, with shares off about 2% after mixed earnings result. Slight miss on the top line, but a beat on earnings. Revenue coming in at $55.27 billion versus estimates of $55.58 billion. That is still a 6.5% year-over-year increase. On earnings per share, $3.30 versus the estimated $3.20. Now, if we take a look at overall same-store sales, excluding fuel and foreign exchange, that grew 6.8% in the quarter versus estimates of 6.2%, so a beat there. And we also saw U.S.-based same-store sales and international sales beating estimates, with international sales up a whopping 9.5%. In terms of those membership fees, I'm not seeing any headlines right now about them raising those fees. Potentially, this could be addressed on the earnings call. Costco tends to increase their fees every 5.5 years, which means we are due for a price hike right now. The last price increase happened in June of 2017. We'll see again if we get that announcement on the earnings call later this afternoon. But I will say that revenue for membership fees in the quarter, that came out to $1.03 billion. That's just shy of estimates of $1.04 billion, but another year-over-year increase of 6.2%. Another thing I'm going to watch on the earnings call is I'm going to want to look for more detail surrounding consumer spending patterns and how that could potentially be shifting given these macro environment. We saw from Walmart and Target and even from Macy's earnings call this morning that consumers are pulling back on discretionary spending. They're leaning more heavily into services, so those essential items like fresh food. So I'm going to want to have a little bit more color and commentary surrounding those patterns. And Shauna, myself, along with Brad Smith, we're going to be breaking all of this down in our After the Call special later this afternoon. So more to come from Costco.
We really ought to get you that $1.50 hot dog and soda combo.
I love a good hot dog.
So good.
We really ought to hook you up with
Please,
that.
I love the hot dog.
All right, Ali Canal with the numbers from Costco. Coming up, we'll take a closer look at our company of the year and their Q4 earnings report after the break.
Brad Smith here with Shauna Smith. We've got your After the Call coming up, and this time we're talking about Yahoo Finance's 2022 Company of the Year is Costco, ladies and gents, boys and girls. Tune in after their earnings call ends because that's when we begin discussing what the tenor and the vibe of the call was.
I will be watching any trade down or any commentary about their private label brand, Kirkland, one of my favorites. And then also their membership fees, and talk about whether or not that will be raised.
I, like many other golfers out there, might be a fan of the Kirkland golf brand and the balls there, but at the end of the day, it's those discretionary categories that have been weakness for Walmart, for Target. Could it be Costco as well? Best thing you've ever bought from Costco?
One of the things I love from Costco, underrated, their socks.
Pesto butter salmon. Tune in, everyone. Brad Smith, Shauna Smith, we've got you covered after the call.
Silvergate Capital, look at that, closing off 57%. Shares taking a nosedive after the company delayed its quarterly release. David Hollerith is here with the latest. And David, lots of questions just about that path forward here for Silvergate Capital at this point.
Sure, yeah. So Silvergate released preliminary results for Q4 in January, saying that it suffered nearly $1 billion in losses over the fourth quarter. But it still had to release a final annual report, its 10Q. And last night, it issued a notice saying yesterday it wasn't going to be able to make an extension time to file that 10Q. So this is actually harkens back to sort of signals that have come up in the financial crisis, which is typically when a company can't turn in their 10Q on time, it's a bad sign. And the company went as far as to express general concern over its own ability to operate going forward. Now, as part of sort of what it has reported, it said that its losses are going to be worse than what it said they were going to be in January. And part of that is due to the fact that they had to sell debt securities to pay off for loans they borrowed from the Federal Home Loan Bank. It's also been investigated by, or under investigation by, a number of regulatory agencies. it has alluded to in the notice. And Silvergate hasn't been accused of any wrongdoing at this time, but there's a lot of concern about whether or not it can operate going forward, especially when it's coming from the company itself. And the company has not added any more comment other than to say that it's working diligently to turn in the 10K.
All right, as with any of these stories, David, we're wondering about collateral damage. How does this impact other crypto companies?
Yeah, that's a good question. I mean, generally, when you think about a bank, especially one that caters to crypto exchanges, for market makers and for exchanges, there's going to be less liquidity available less quickly. But that being said, several crypto firms have quickly come out to distance themselves from Silvergate, including Coinbase, Paxos, Galaxy Digital, UK headquartered exchange, Bitstamp, Gemini, Crypto.com, and Circle. And none have confessed to have material exposure to Silvergate, meaning that this is somewhat of an isolated situation, at least as of now, from what these companies are saying. They've all said that they've made this decision out of an abundance of caution. MicroStrategy, which is also the largest corporate holder of Bitcoin on its balance sheet, said that it did borrow loans from Silvergate, which are due in 2025, and those loans will not be accelerated even if Silvergate goes insolvent. So for now, for the time being, from the people we have heard from, it sounds like it's relatively isolated. That being said, Binance US and Kraken have both decided not to comment on Silvergate.
All right, a story that we will continue to follow. David Holler, thank you. When we come back, we are diving deeper into Costco's latest results. The stock down just about 2%. We'll be right back. Right, shares at Costco off just about 2.5% following its most recent results here. A mixed picture here from Costco. EPS beating the street's estimates, $3.30. Revenue, though, coming in a bit light, $55.27 billion. Total comp sales here up 5.2%. In the U.S., total comp sales are up 5.7%. Let's talk about these results with Arun Sundaram. He is a CFRA analyst. Arun, great to have you here. So just first, your take on this and the drop that we're seeing in extended trading with Costco.
Hey, yeah, thanks for having me. Yeah, I mean, overall, I thought, it was overall good results, a good bottom line beat, EPS at 330. The consensus was 320. We actually estimated 332 in EPS, so slightly below our expectation. Maybe the only area that I can see that showed a little bit more weakness was in the operating expense line. Operating expenses was a little bit heavier than we expected, up about 8%. Year over year, and that resulted in some operating expense deleverage, and that could be a little bit worrying because for these big retailers, these retailers need to generate strong sales growth in order to lever operating expenses, and so even though we saw pretty good sales growth, we did see some SG&A delever this quarter. So I think that's the part a little bit worrying here.
Always limited surprises with Costco because you get the monthly sales numbers. So anything really surprise you in the numbers you're seeing today?
Yeah, you're right. I mean, on the top line, nothing surprised us there. As you said, Costco is one of the few retailers to release monthly sales figures. So for November, actually, when they released November sales figures, that was a big surprise to the downside. November results came in weaker than the street anticipated. Comp sales in November was 5.3%, and that was a little bit worrying, especially given where consumer spending was heading. But you saw a pretty good rebound in comp sales in December and also in January. In December and January, comp sales came back up and it was above 7%. So a nice rebound from that 5% in November. So good momentum on the top line. We'll see if this can continue because understandably, for Costco as well as throughout retail, discretionary spending is under pressure, and that will likely continue to be under pressure for the rest of this year. So we'll hear more on the earnings call today of what they're seeing exactly in terms of their discretionary mix, which doesn't make up a huge portion of Costco's sales mix, but it is a sizable portion. But Costco is predominantly a food retailer. Over 50% of Costco sales is in that food space. So that discretionary mix is relatively limited, about 25-30%.
Arun, what does all that tell you then about the debate around membership fees, when we would potentially see a hike? I don't see anything in this release on raising membership fees. I'm sure we will either get a question on it or executives commenting on the potential for that. What are you expecting?
Yeah, everyone's expecting a membership fee increase. I think it's imminent. Costco typically raises membership fees every 5.5 years. The last one was in 2017. So, if history is any sign, then we're likely to see one this year. I think Costco has leverage to raise membership fees this year, especially given that Amazon raised their Prime membership fee last year in the U.S. from $119 to $139. I think that gives Costco a little bit of leverage to also raise their membership fee here, given that both Amazon and Costco they predominantly tailor to that middle income to upper income consumer base, which is they're faring a little bit better than that lower income consumer base right now.
But don't you dare mess with that $1.50 hot dog and chips and soda combo. Yeah, Sam's Club also raised their prices in August, so they also have some leeway there. But it's only around 2% of their revenue. So how significant a part of the investor story would that be if they're to increase the membership fee as expected?
Yeah, I mean, it's a small portion of their revenue, but you have to remember that hiking membership fees is almost 100%. Of a margin. All that benefit flows to the bottom line. So Costco the majority of Costco's operating profits come from the membership fees, not necessarily from selling goods inside their store. So for Costco, it's the most important thing for Costco is to continue to gain new members and also retain the new members that they gain. And the good news is that they have significantly gained members since the pandemic began. They're up about 20% in their membership base since 2019. And the best part is when Costco gains members, rarely do they leave, because the Costco's renewal rates are about 92% about in the US and Canada, and 90% worldwide. So really strong, loyal customer base. I always joke around that Costco kind of has a cult-like following, similar to maybe some of those Tesla investors out there. So they have a really strong loyalty program, really strong customer base. I think the big thing going forward is, can they continue to gain new members? They've already gained a significant amount since the pandemic began, but where is this incremember membership base going to come from?
Yeah, they do have a cult-like following. Dave is a new member
joining
of that cult. Yeah, exactly. Arun, Dave visited his Costco for the first time, I think, in quite some time ever.
Listen, Thin Mint pretzels, Arun. Thin Mint pretzels. That's all I'm going to say here.
There you go. You got the bullish case from Dave. But Arun, you have a hold rating on the stock. What would be the catalyst, or what would get you off the sidelines to have a more bullish view of Costco going forward?
Yeah, it's really due to Costco's valuation. That's what keeps us a little bit hesitant and keeps us on the sidelines. Yeah, fundamentally within Costco is a solid story. Good EPS growth, good sales growth, really strong subscription-like revenue with their membership base there. But it's really on the valuation. The shares trade north of 30 times forward earnings. That's one of the most expensive valuations in our big box retail coverage. Walmart trades around 22-ish times. Target trades at around 15 times. So the shares are just a little bit pricey, and that's why we're advising investors just to hold off and maybe wait for a pullback before they get before they start buying any shares there.
Sound advice. Arun Sundaram with the analysis of Costco's Q4 earnings. Appreciate that, sir. Thanks so much. All right, coming up, Republican Governor of Florida, Ron DeSantis, laying the groundwork for a 2024 presidential bid, going as far as taking on Disney, the House of Mouse, in his home state. But is he misreading corporate America? We'll discuss on the other side of the break. Florida Governor Ron DeSantis' beef with Disney could cause a financial storm for the Sunshine State, but it may be the first shot in a potential war against what he calls woke capitalism. For more, we're joined by culture warrior, Yahoo Finance senior columnist Rick Newman. What do you make of this battle with the House Mouse? I thought he was going to let it go. Clearly not the case.
No. So, this is kind of last year's story, but what has happened recently is a couple of things. First, the state of Florida has taken over that municipal district from Disney, and it's now a 5-person board of directors that Disney has to answer to. Those are mostly DeSantis allies. But from my perspective, this matters because DeSantis is clearly teeing up a 24 presidential run. His book just came out. He wrote, I bought the book, and he's got one chapter in there on the whole Disney saga. Here's how I took on woke corporate America. The Wall Street Journal ran an excerpt from that chapter. So this is what happened with Disney in Florida is kind of like his template for how he wants to take on corporate America and this whole thing he calls woke capitalism. Hard to define what woke capitalism is. I think DeSantis himself has struggled to do that.
Everyone has.
Yeah. Suffice to say, it's liberal ideas filtering into corporate decision making. But I think he's misreading what's going on in corporate America and where this pressure is coming from in the first place. So in his book and in the journal article, he characterized this as a small group of, and he uses the adjectives loud and militant liberals, as if it's this small cabal of liberals that's just strong-arming Disney into taking these positions, and it's not. It's cultural points of view, cultural attitudes that have changed a lot over time. It relates to LGBT issues where there clearly is much more tolerance than there used to be, and even a majority of Americans in some ways say, let's normalize LGBTQ issues. That is one of the things DeSantis is kind of pushing back against. This gets into so-called ESG investing, environmentally friendly companies. That is somewhat fraught, but if you just go to the fundamental issue, majorities of Americans want more action on global warming, again, especially young people. And guess who companies obsess over? 18 to 35-year-olds.
They don't vote.
Well, they did. So they do vote eventually. Number one, they vote eventually.
Sure.
And if they do get energized to vote, they can make a momentous difference. I mean,
the Republican base is older voters.
Yep.
You say DeSantis is misreading corporate America. My question is, do you think he cares? Or does he care what resonates with the Republican base?
I think it's both. So that's what I think everyone's trying to suss out at this point. So you're right. This idea of woke capitalism, because it has these cultural touchstones, don't shove liberal culture down our throats. So that does, I think, resonate with I think you call it the MAGA base, the Trump groups. It does not necessarily resonate with what you might call traditional business-oriented Republicans. In fact, some of them have said, let's leave companies alone. Fine to go after the culture issues, but don't punish. Ken Griffin, the billionaire founder of Citadel, has said, I support Ron DeSantis. I wish he'd leave Disney alone. In other words, keep the businesses out of it. So let's say it works and he can win a primary among Republicans. Does that then translate into, can he get traction on this with swing voters? There's absolutely no evidence that swing voters will take up this issue. And in fact, a lot of voters have no idea what this is even about.
Nor do they really care.
They don't really care. They might care about some particular issue, yeah. but they don't even recognize this umbrella phrase of wokeness or wokeism or woke capitalism as a thing.
What about the impact on the all-important donors? Because corporations are the Republican Party's biggest donors. If you're taking on corporate America, how are you going to raise, and you're going to need hundreds of millions of dollars
to run
for president.
They are not as important to Republicans as they used to be, or as many people think they are. And this has to do with all the shifts we've seen in politics during the last 10 to 20 years. One big one is the ability to raise political funds on the internet through small donor donations. And guess what Republicans have gotten very good at? Using the outrage factor to get millions and millions of dollars in donations. Trump has excelled at this, and he has continued to be a fundraising juggernaut, even as he's under investigation everywhere, and he fomented the January 6th riots. Marjorie Taylor Greene, the bomb thrower from South Carolina, she raises tons of money And these are extreme
and those
politicians.
are not corporate dollars.
And they are not corporations supporting those people. So they don't need big business as much as they used to.
Prediction, DeSantis is going to be taking on Hershey any minute now. I don't know if you've seen that whole story, but this is right.
I guess that's my next column.
It might be ripe for the next Rick Newman column. Good to see you, sir. Thank you.
Thanks, Dave.
All right, Costco, not the only company making moves in after-hours trading. We'll tell you what has Zscaler and others shaking up Wall Street next.
All right, we've got a couple of after-hours movers here for you. Dell, C3 AI, Zscaler, and ChargePoint. Kicking off with Dell, that stock moving to the upside in extended trading here. Taking a look at that, up just about 1% here. Revenue of $25 billion, beating the street's expectations. The CFO also retiring, so a bit of a change up there in the C-suite. The company also raising its quarterly dividend over the last 3 months. You've seen Dell under a bit of pressure, off nearly 10%. Let's take a look at C3 AI. This company has certainly gained a lot of momentum recently, up another 14% in extended trading here. Their current quarter of revenue guidance beating the street's expectations. C3 AI is seeing revenue of 70 to 72 million. This stock has certainly taken off since the start of the AI boom, noting in this earnings release that they have seen a dramatic change in business sentiment compared to what they experienced in 22. So let's take a look at a year-to-date chart, talking about that euphoria that certainly has hit the stock. You're looking at gains of just about 90%. Comparing that to a one-year chart, totally different story. You can see that's actually in the red over the last year, off just about 6%. All right, moving on to Zscaler, another name on the move in extended trading, off just about 12%. The company initiating a workforce reduction. They're cutting 3% of their workforce. That equates to about 150 positions there. So just the latest name to announce job cuts here. They're going to take an $8 to $10 million charge. But the reason that we're seeing the stock under pressure here after hours is because the company missed on deferred revenue. Deferred revenue for the quarter, $1.1 billion. That was less than the street was expecting. Over the last 3 months, looking at gains of just about 4%. Rounding it out with ChargePoint Holdings, this EV charging company posting a wider than expected loss. We're looking at losses of about 13.5% here in extended trading. Sales disappointed during the quarter. The company blaming supply chain challenges for some of its recent troubles. Over the last 3 months, you're looking at losses of about 3%. Over the last year, the stock off about 20%, Dave.
Oh, all right, Shauna, thank you. It is closing time here at Yahoo Finance. Let's take a look at some of the biggest stories of the day. Costco reporting a mixed second quarter earnings report. Yahoo Finance's 2022 Company of the Year reporting second quarter earnings of $3.30 per share, topping analyst estimates of $3.20. Revenue, though, coming in a hair lighter than expected at $55.27 billion. The report sending shares lower and after hours trading down 2%, Sean.
Let's turn to another big retailer that reported after the close, and that's Nordstrom. The company missing revenue estimates in Q4, but earnings met expectations. The retailer announcing that it's winding down support for its operations in Canada with CEO Eric Nordstrom saying, quote, "Despite our best efforts, we do not see a realistic path to profitability for the Canadian business." You're looking at shares up just about 0.6%.
And finally, we have Tesla. Investors sending shares lower after what many viewed as a disappointing Investor Day presentation from the EV maker. CEO Elon Musk unveiling his Master Plan 3, which included updates on AI, charging infrastructure, and that it would be building its next factory in Mexico. But it was not enough for some Tesla watchers who were hoping to see Tesla unveil its Generation 3 vehicles. Okay, the month of March always among the very best in television viewing as it concludes with March Madness. But that's not all this year. It's also when HBO's hit series Succession, that's based loosely on the Murdoch family, begins its final season. Logan Roy returns March 26th for the season 4 debut. Today, the full trailer was released, and it is spectacular.
Why does everyone ask how I'm feeling? I got done a huge deal. I got the election. I got ATM. I got plenty on my plate.
He's on the floor, Tom.
Explain to me what he's doing.
He's moseying, terrifyingly moseying. It's like if Santa Claus was a hitman.
Just chills, I think, for everyone who is a huge fan of Succession. So that might have excited you. But that's not the best part. A very familiar face making a cameo at the very end of the trailer. Can we show that part here? Because we have our very own Dave Briggs positioning himself very strategically right behind Logan.
Yeah, man, if you want to get on camera, you wear a suit and you stand right next to Logan Roy. That was perfect positioning. That was just such a fantastic pleasure. I can't reveal any plot twists here, but watching that man do his thing, his craft, was one of the most inspiring performances I've ever been around. Like being around Michael Jordan shooting a basketball when he's hot. It was just remarkable to watch him. Those applause were spontaneous.
Really?
They weren't in the script. We were all just thrilled at what he just delivered. That's all I can say.
What was your favorite part? Because you spent a lot of time filming this. And when you take into account all the time that you had spent doing this, just your favorite part of it? I guess it's all the hype, that right there?
That right there. A lot of news anchoring,
Yeah.
but watching him deliver a speech and bring those applause, that man is brilliant. But it's not about me today. It's about you, Shauna. Happy birthday. We've got some cake for you. We've got the crew out here to deliver. Guys, come around the back. We got to get you on camera.
And we got to point out Sydney's birthday tomorrow, too.
Our fantastic, extraordinary producer, Sydney. But
thank you, guys.
Happy birthday to both of you.
Well, obviously, I wouldn't want to celebrate it with anyone else but you guys, which is why I'm here on my birthday. But thank you, guys. That's so sweet. I had no idea until I was tipped off in the commercial break.
But, you know, they're great producers, but they didn't bring a knife or forks or plates.
That means it's all mine. I can just go right in with my fingers and make sure it's off limit for all of you guys.
Happy birthday, my
Thank
friend.
you.
That'll do it for us for Yahoo Finance Live. Be here tomorrow, 3 o'clock Eastern Time for all your coverage leading up to and after the closing bell.
Guys, please. Bye, guys. Thank you. Guys, this is so sweet. Sid, I wanted you right here, front and center.